5 stocks I like right now. Number 1, Amazon. Amazon reported earnings recently and the numbers looked good. All 7 of its business segments are growing. Third-party seller services grew 18% year over year, advertising grew 22%, and AWS grew 12%, and the company has been making solid investments in fulfillment and AI. Amazon is currently valued around 1.4 trillion, which is roughly 22 times EBITDA, and that valuation is near the bottom of its historical range. Amazon remains a high-quality business, and I'm planning to hold the stock for the long term. Number 2, Crocs. Everyone seems to love Crocs at the moment, and Google search data shows the brand is near an all-time high. Revenue was up 11% in the latest quarter, and sales in Asia increased by over 30%. Despite that, Crocs stock is down 13% this year, giving the company a valuation of less than 9 times earnings. The company does have $2 billion of debt, which it used to purchase footwear brand Hey Dude, but Crocs also has impressive profit margins, and I think 9 times earnings is just too low for this company. Number 3, Taiwan Semiconductor Manufacturing Company. TSMC manufactures microchips that are used in smartphones and other devices. More than half of the company's revenue comes from advanced microchips of 7 nanometers or less, and TSMC also supplies chips to Nvidia. There's no doubt we're going to need more of these chips in the future, and TSMC has a long history of growth with solid operating margins of 38%. Right now, oversupply has caused the company to forecast a 10% drop in revenue, and that news has taken the stock down about 10%. But when the cycle picks up, I think TSMC is going to get back on track, and so I think the shares look good value at just 16 times earnings or 10 times EBITDA. Number 4, AirSale, ticker symbol ASLE. This is a small cap company that we wrote about on our website. The business provides services to airlines, and it also buys and sells its own aircraft. The stock has fallen 30% this year, but we think that's an overreaction. Right now the stock is valued at about 11 times EBITDA, but when you account for inventory and other factors, that valuation drops to about 7 times. Some company insiders have been buying the stock, and there's a potential catalyst on the way that could bring the company a massive boost to revenue. Number 5, Global Uranium ETF, URA. This one isn't a stock but an ETF that provides exposure to a range of companies involved in the production of nuclear components and uranium mining. It's simple. To combat climate change, we need to stop relying on fossil fuels, and nuclear power is efficient and clean. In fact, the World Nuclear Association claims that nuclear is cleaner than solar when measured across its whole life cycle. Various countries are starting to build out nuclear reactors, and this growth should push up the price of uranium, and that should boost the value of this ETF. Commodity prices move in cycles, so I'll be looking to hold this investment until the cycle starts to turn back down. But these are my personal opinions, not financial advice, and I do hold shares in all of these stocks. If you're looking for more detailed investing ideas, make sure to visit our website overlookedalpha.com.